Hey everyone, welcome back to Corporate Decoder. Today, HFU's Hartford Creative Group, Incorporated, just filed their Q3 2026 report, and there is a serious going concern warning we need to talk about. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company is growing revenue. But the numbers also paint a picture of a business teetering on the edge. Alright, let us dive into Hartford Creative Group's latest filing for the quarter ending the 30th of April. 2026. First off, the company is still officially a non-accelerated and smaller reporting company. This means they have fewer reporting obligations, but it also often signals a smaller operation that might be more vulnerable. Looking at their balance sheet, total assets have shrunk from about $6.9 million in July of 2025 to just over $4.1 million by April 2026. That is a significant drop of nearly 40%. Their cash position has improved, moving from about $57,000 to $160,000. That is a good sign for short-term operations, but it is still a very small amount for a company of this type. Now, here is something interesting. Their advance to contractors has dropped from over $6 million to just about $3 million. This suggests they are not prepaying as much to their contractors, which could impact relationships or indicate a change in their business dealings. Overall, their current assets, which are assets that can be turned into cash within a year, have fallen from $6.5 million to $3.7 million. On the flip side, their contract liabilities, which is essentially money owed to customers for services not yet rendered, have also decreased dramatically from $4.8 million down to $851,000. This indicates that they have fulfilled a significant portion of their future obligations or are no longer taking on as much upfront payment. Total liabilities have also decreased, but not as dramatically as assets. They were at $6.6 million and are now around $3.2 million. This is a positive sign, reducing their overall debt. The number of shares outstanding remains steady at about 25 million. This is important because it means they have not issued new shares to dilute existing shareholders recently, at least not in a way that changed the total count in this report. Their accumulated deficit, which is the total net losses from the company's inception, has improved. It went from a negative $4.8 million to a negative $4.1 million. This means they've had a profitable quarter that has started to chip away at their total losses, which is definitely a step in the right direction. As a result of these changes, their total stockholders' equity has gone from a deficit of about $300,000 to a positive $934,000. This is a significant turnaround, showing they are moving towards a positive equity position. Now let's look at the income statement to see how they made that equity grow. Revenue from advertising is up substantially. For the 3 months ending the 30th of April 2026, they brought in $1.05 million compared to just $354,000 in the same period last year. That is a massive 196% increase. This surge in advertising revenue pushed their total revenue to just over $1 million for the quarter, up from $354,000 last year. The cost of revenue went from zero to a small amount, $712. This is tied to their new mini drama content, which is still in its early stages. Selling, general, and administrative expenses, which are your day-to-day operating costs, increased by about 26%, from $169,000 to $213,000. This is expected with growth, but it is good to see revenue growing much faster. And the most exciting part here, operating income jumped from $184,000 to a whopping $836,000. That is a nearly 353% increase. This clearly shows the business is becoming much more profitable. Income before taxes followed suit, soaring from $186,000 to $833,000. And their income tax expense also rose significantly from $95,000 to $276,000 as a consequence of their higher profits. Ultimately, this led to a net income of $557,000 for the quarter, a massive 512% increase from the $90,000 they made last year. This is the core reason their equity position improved so much. The number of weighted average shares outstanding remained unchanged at 25 million, which means this profit growth is not being diluted by new share offerings. Looking at comprehensive income, which includes things like foreign currency translation adjustments, they also saw a solid increase. Their total comprehensive income rose from $132,000 to $576,000. This statement breaks down the changes in equity. You can see the net income from the period adding nearly $557,000 to their equity. This brings their total equity to a positive $934,000, a significant improvement from negative $2.9 million at the same time last year. The change from the 31st of July 2025 to the 30th of April 2026 shows a jump from $299,000 to $934,000 in equity. Let's see how this translated into cash. Net income was $614,000 for the 9 months ending the 30th of April 2026. However, when we look at the adjustments, we see a large negative change in contract liabilities, down by over $4.1 million. This means they either completed a lot of work they were paid for in advance, or they are no longer taking large upfront payments. They also advanced significantly more money to contractors, over $3.4 million in the 9-month period. This is a big use of cash. This all resulted in negative cash flow from operations of over $338,000 for the 9 months. This is a stark contrast to the positive $124,000 they had in the same period last year. Even though they are profitable on paper, the actual cash generated from their core business is currently negative. Investing activities show a small outflow of about $10,000, mostly for app development. Financing activities provided over $449,000 in cash. This came from borrowing money from related parties, which is a common tactic for companies in this stage. However, it was also offset by payments for offering expenses. Overall, their cash balance increased by about $103,000 to $160,000. The company is shifting its focus to media and marketing services in China, and they are launching new ventures. They had a 1-for-4 reverse stock split in March 2025. This is often done to boost the stock price per S-hair, making it appear more substantial, but it does not change the company's overall value. Their revenue recognition policy explains they are acting as an agent for advertising placements, meaning they take a net amount. However, for their new mini drama business, they are acting as the principal, recognizing revenue on a gross basis. This is a key distinction for how their financial results are presented. They also launched a mini drama app called YWise in April 2026, which is expected to generate revenue from subscriptions and ads. They are capitalizing app development costs, which is standard practice, but it means these costs are not expensed immediately. This is the most critical part of the filing. The company explicitly states there is substantial doubt about its ability to continue as a going concern within 1 year. This means the auditors are warning that the company might not be able to stay in business. Management believes they can improve things with revenue growth and operating income, expecting it to boost cash flows. However, they also acknowledge they might need additional financing, including from related parties. Crucially, the financial statements themselves do not include any adjustments for this going concern risk. This is standard practice, but it highlights the uncertainty they are facing. This going concern warning is similar to what we saw with companies like Bed Bath and Beyond and Rite Aid before their struggles intensified, often leading to significant value destruction for shareholders. Historically, about half of microcap companies with reverse splits and going concern warnings eventually get delisted. There are significant related party transactions. Money is being lent and paid to entities associated with major shareholders and management. While this can be a lifeline for a company, it also raises questions about transparency and potential conflicts of interest. They mention a 5% annual interest rate on some loans from Hartford Hotel Investment Incorporated. This note details the large movements in advances to contractors and contract liabilities, which we saw impacting their cash flow. They have a significant concentration risk. For the 3 months ending April 2025, 2 customers accounted for 85% of their gross billing. While this has improved, in the recent quarter, 2 customers still accounted for 26% of their billing. This reliance on a few big clients makes them vulnerable if one of those clients leaves. Similarly, they rely on a few contractors for their services. They've identified a significant deficiency in their internal controls over financial reporting. It relates to how they handle rebate agreements, which are often based on informal or verbal agreements. This lack of formal documentation could lead to errors or disputes. They are working on formalizing these agreements. But this weakness is a red flag for financial accuracy. The management's discussion confirms the significant revenue growth, particularly in advertising, which they attribute to optimizing their client portfolio and renegotiating terms. They've also entered into framework agreements with major customers, which they expect to boost future revenue. The new mini drama app HFUS is part of their plan, aiming to expand content rapidly. The dramatic revenue growth is evident here, with advertising revenue up 196%. The increase in net income was over 500%. This is a strong performance indicator. Looking at the 9-month period, Total revenue increased by 31% and net income rose by 70%. While good, it is not as explosive as the quarterly performance, which might suggest the most recent quarter was exceptionally strong. Despite the improved profitability, they estimate needing about $2 million over the next 12 months and acknowledge that funding this will likely require related party financing or new equity issuances, which means more dilution for existing shareholders. Back to the cash flow statement, they clearly state negative cash flow from operations for the 9 months ended the 30th of April 2026 was over $338,000. This is where the going concern warning really hits home, profitable on paper, but bleeding cash. They confirm they have no off-balance sheet arrangements, which is a positive. No changes here. As a smaller reporting company, they are not required to provide this detailed market risk analysis. This section reiterates the significant deficiency in internal controls regarding handshake rebate agreements, which they are working to fix. Standard certifications are included as expected. Alright, so what is my take on all of this? Hartford Creative Group is in a very interesting spot. On one hand, they are showing impressive revenue growth and profitability in their advertising segment, and their new mini-drama venture is gaining traction. This is a huge positive, and it is great to see their equity position turning positive. However, the going concern warning is a massive flashing red light. Companies that issue these warnings are often in serious financial trouble. While they have a plan, that plan relies heavily on future revenue growth and potentially more financing, which is not guaranteed. The reliance on related party financing and the lack of formal controls over key business dealings are significant risks. The comparison to companies like Bed Bath and Beyond and Rite Aid before their difficulties is a stark reminder of how quickly things can go south for companies in this position. The current cash flow situation, despite on-paper profits, is also a major concern. The biggest risk I'm watching is whether they can generate enough sustainable operating cash flow to actually meet their obligations without relying on further dilution or expensive related party debt. What I am actually looking for is a sustained trend of positive operating cash flow, not just book profits. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description.